Yo. Hello, guys. This is David Capable in the building. Today, I'm going to be your Forex tour guide to take you through the basic of Forex trading. This is imperative because it's usually your springboard to your great success stories in trading the Forex market. So, without further ado, I will want you to sit back, relax, and listen very carefully to what I'm about to dish out because it's going to soar you high in your Forex trip. Alright, guys, so let's get down to business. What is Forex? Forex is an acronym for foreign exchange, the largest financial market for exchanging different currencies. Forex simply means when two country currencies are being exchanged. Forex have taken place. For example, if I want to travel from my home country, Nigeria, to go to the United States of America, I will need to exchange my country currency, which is Naira, NGN, abbreviated at NGN, to the United States dollar currency, which is abbreviated as USD. Okay, the US dollar, at the United States dollar. Now, when I get to the United States, I need to exchange my currency for that to get into the country. If not, I may not be allowed to carry out other exchange that I want to carry out, because I can't get into the United States and say I want to use my Naira to do business or transact something. I will not be able to get to do business except I've exchanged my Naira to dollar. I could do that before I get in from the bank and all that. So in Forex, when two country currencies are being exchanged, Forex have taken place. So now, right now, there are some basic things you need to understand about Forex. First and foremost, you need to understand that these country currencies are actually abbreviated. These country currencies are actually what? Abbreviated. Now, and you also want to understand that in the Forex market, currencies are traded in pairs. Like, for example, we have USD versus Great British Pound. Okay, the US dollar coin versus US dollar, and the Great British Pounds, and so many. They are actually traded in pairs. You need to also understand that the Forex market is actually open for 24 hours and 5 days in a week. It closes down during the weekend. Very imperative and very important to note that. The Forex market is all about just buying currencies of different countries. Okay, now the Forex market is also open to central banks, companies, financial institutes, and individuals and brokers. So it's not like before when it was actually restricted to some few, but today it is actually open to everybody. So you and I have free access to the Forex market, and this Forex market actually, as we said, it opens for 24 hours in a day and actually 5 days in a week. It means it actually has an overlapping time zones. Okay, it has an overlapping time zones. Now, the time it's actually a market is opening in a particular country, it may be when that or the next country may actually be closing. So this time sections, the time zones actually overlap against each other. So we have the Asia time zone that opens from what you can see here. It opens first, followed by the London section, then followed by the New York section. These time zones overlap each other. As the Asia section is about closing, immediately the London section is opening. As the London section is about closing, immediately the New York section is opening. So you need to understand that there are time zones. Whatever time zones you want to trade within the country you find yourself is good. You are good to go. Then, like I said, currencies are traded in pairs. Now, if currencies are traded in pairs, these currencies have what is known as the base currency and the code currency. The first currency you see, which is actually at the left-hand side, is actually called the base currency, while the one you see on the right-hand side is actually called the code currency. So the trading of these two pairs together is actually when Forex have taken place, because you are exchanging these two currencies, these pairs together. Okay, so but you need to understand, one is a base currency and one is a code currency, as you can see clearly from the picture. It has been shown. Then proceeding, since you know you are trading one currency against another, one is the base currency while the other one is the code currency, you need to understand that for you to gain access to Forex market, you need to go through a broker, and this broker charges you a fee. And that fee the broker charges you to gain access into the Forex market is actually what is actually known as the spread. The broker charges you the spread. So what is a spread? The spread is the difference between a Forex broker's sales rate and the buy rate when exchanging or trading currencies. So when you are exchanging currencies, there are actually differences between the sell rate and the buy rate. Those sell and the buy rate are actually known as the bid price and the ask price. The difference between the both of them is actually what gives birth to spread, and that is what the broker charges as his own fee. So you can see very clearly from the picture here, we have two currencies, Great Britain pounds and the USD dollar, and you can see the differences. You can see the bid price and you can also see the ask price. You can see the two differences. Now it gives what the spread is. That is exactly what your broker charges as his own broker's fee, known as what? The spread. So let's proceed. Now, if you have understood that, you have to also understand that these currencies, like we said, that are in pairs, they have different types of currency pairs. Now, there are three different types of currency pairs. The first currency pairs is known as major currency pairs. The major currency pairs are the most traded currency pairs in the Forex market. As you can see them, very obvious here. It is clearly shown in the picture. Euro versus US dollar, the Great Britain pound versus US dollar, the US dollar versus Japanese yen, the US dollar versus CHF, which is what? Switzerland and Switzerland and franc, that you can see. Then we have the US dollar versus CAD, which is actually the Canadian dollar, the Australian dollar, which is UAD versus US dollar. Very simple. These are the majorly traded what? Currency pairs in the Forex market. They are commonly traded. They are dominantly traded. Okay. Then the next one is actually called the cross currency pairs. They are the pairs that follows the major currencies, major currencies. Okay, so some people call them minor currency pairs. Now here you can see these are also popular currencies of different countries, but they are not paired against the US dollar. So any popular currency that is traded in the Forex that is not actually paired with the US dollar is actually a cross currency pair. That's why you see a Great Britain pound, very popular, traded against what? The CAD, which is a Canadian dollar, which is also a very popular currency. We know is under the cross. Then we have the euro being traded against the Great Britain pound. We have two popular countries currency traded against each other. They all fall under the cross pairs. But remember, in these pairs, the US dollar is not in the picture. Okay, so that is why it's called a cross pair. Then the next one, which is the last one, is actually called the exotic cross pair. The exotic cross pair, the difference between this exotic and the rest is just simple. One dominant and prominent currency is actually found in the picture of the pairing, followed by a non-relevant and maybe less traded and non-recognized pair. That is why you can see a US dollar paired against a Singapore dollar. So who actually knows about Singapore dollar? Nobody actually read. It's a currency but not actually mostly traded. Just it's not dominant. Yes, and it's inferior. Yes, sir. Let me use that word, inferior to the US dollar. US dollar is very popular, so it's dominant. So if a dominant pair like the US dollar is trading against an inferior currency like that of Singapore dollar, we can say this is an exotic pair. Just like we have the US dollar versus the Danish krone. The Danish krone is abbreviated as DKK, as you can see from the picture. Just look at the picture clearly, you can understand it. It's already pictorially shown to you. All right, so I've explained the three types of currency pairs already to you. What did I mention first? I mentioned the first one. What did I say? The first one is what? The major, then followed by the cross, then followed by what? By the exalted. Very simple. Then let's move to the next thing, which are the forex terminologies. Very important terminologies in forex you need to grab as a forex trader. The first forex terminology you need to grab is called equity. What is equity? Equity simply means the total amount a trader has in his or her forex account or balance. Simply put, capital base. Now, in your normal conventional language, when someone asks you how much do you have in your bank account, you said I have so amount and so amount there. But in forex, we don't say this is what I have in my balance. We use the terminology, the right word, which is called equity. Equity is just your balance, the balance that you have in your forex account, either when you have funded your account, your forex account, or after you have traded and you have made profit and loss. At the end of the day, what you have at your balance in your forex account is actually what is known as your equity. What you have in your forex account is actually what is known as what? Your equity, your capital base. Very simple. Next item you need to also understand is the lot size. What is lot size? In forex, we often hear lot size. When traders said they are going to use so lot size to so trade, they simply mean, or they are simply telling you that they are just using just a fragment, a portion of their equity to risk the market or to bet or to trade into the market. I'm using all this basic terminology for you to understand, for you to understand perfectly. Okay. Now, if I have an equity of $100 and I'm just taking maybe 2% of it, 20% of it, meaning I'm taking 20% of $100 is what? Is $20. Did you get it? So that 20% I use, the percent is actually what is actually known as the loss size, because the loss size is actually calculated in percentage. Just a fragment, a portion of what you have as an equity is actually what you are taking, you are risking to trade, is actually what is known as your lot size. So the amount a trader is willing to risk to take a trade, usually a fragment of the equity, and is calculated in what? In percentage. I have $100 equity and I'm only taking only 0.2. 0.2 means 20% of amount, which is equivalent to what? $20 to trade. Or I am actually only taking only 10%, which is actually what? 0.1. That's $10. I'm risking only $10. Fine. Okay, if I'm only risking less than that, I want to risk only $1, which is 0.01 lot size. Okay, so meaning I'm using only 1% of my equity. So these are basic things you need to understand. So it's always advisable to use manage your lot size very well, so that you won't use all your money to trade, and when you lose and you start crying foul and you start having premium tears. No. So always learn to use very good risk management and principle, which is medium risk or your low risk for your lot size. Manage your lot size very, very well. It's very, very important. Okay, so let's proceed. So we're proceeding. The next forex terminology we're talking about leverage. I don't need to say much about leverage. The word leverage simply means like a borrowed fund. When your broker allows you to use more than what you actually have in your equity, invariably you are enjoying what is called leverage. Okay, so leverage is the use of borrowed funds to increase one trading position beyond what will be available from their cash balance, equity in bracket alone. This is usually given by the broker. When your broker, like I said, is just a financial institute that gives you the platform for you to trade forex. So when they allow you to take more than what you have in your equity to trade, means you are enjoying leverage. It's always advisable to use low leverage. Please don't use too much leverage. If you use much leverage and the trade goes against you, you are going to be paying out of your equity. But if it goes in your favor, then that's good. All right. So very good forex terminology, well explained. Then the next one is actually the PIP. PIP simply means percentage in point or percentage in price. You and I understand that the forex market is all about price movement. Whether the price is moving upward, which is called bullish, or uptrend, or the market is coming down, which is called downtrend or bearish. The price movement, it's all about price. It's all about money. Forex is all about money. It's about price in the market. The price movement in this market is being controlled by a unit of measurement. That is being measured in a unit. Is being measured in a unit, and that unit is actually called pips. Just like we have length and breadth. When we did physics in school, we said when you want to calculate distance, we say time, distance over distance, and you want to calculate distance over time or speed over this and all that. Those are units of measurements. So here in Forex, the unit of measurement for the price movement is called pips. When price moves upward, we use pips to calculate it. When price comes down, we use pips to calculate it. So your unit of measurement to express the change in value between two currencies is called a pip. When there is a change in two currency pair, this change in currency and in the value of currency pair is actually measured in price. Okay, but this price has a unit of measurement which is known as pip. So we don't say the price has moved to 150. No, we will say it has moved so pips. If you say the price has moved from 150 to 170, we say okay. We will say how many pips did it move. If it moved from 150 down to 130, we said how many pips did it move. So we talk about pip. So the forex market is all about pipsology. Okay, let me use that word, pipsology. Okay, so let's proceed. Now this is how to calculate the pips. The pips is actually calculated in, as you can see, is actually calculated in 4 to 5 decimal places. Very important points to note. Now after the decimal point, after the first decimal point, the first decimal point after the dot is actually 2. That point, the unit there is 1000 pips. Followed by the next second decimal point after decimal point, second place is what? Is 100 pips. The third one is what? 10. The fourth one is actually what? Is 1 pip. While the last one is what? 0.1 pips. Anything after the fifth one is actually called piplet. Piplet means P-I-P-L-E-T. Means it's not really relevant. But any movement across these particular zones, these 5 decimal points, should be measured within the units it is. So that's why when you look at this thing very closely, you can see this green numbers where it's been highlighted. It means where the price have moved to. So if the price have moved to from this 2435 to 24745, how many pips has it moved? You ask yourself, where does this 3 fall into and this fall into? It actually fall where? In the fourth decimal point, and the fourth decimal point falls under what? The fourth decimal point, what does it fall under? It falls under 1 pip. So the movement between that and that place is also only 1 pip. Look at the next one. The green highlighted, 7 highlighted green, followed by the 8 highlighted. The third decimal place is in tenths. Do you get it? So we have 10 pips. The next one, which is 100 pips, for the next one followed by 1000 pips. So that is how it is. It's measured in decimal points. So this is very important. There is also a pip calculator you can use and download from your Google store, Google Play, to use to calculate your pips. Very important. And we move to what is take profit. Take profit simply means an order automatically closes an open order when the price reaches a specific threshold. You can take your profit. Going long, that's bullish, or going short, bearish. Now, like I told you, the forex market is all about either the market is going up, is going down, you take your profits. Okay, so if you anticipate the market is going to go up, it means you're going to place a buy order and your take profit is going to be up above your current market price. If you anticipate the market is going to come down below your current price, it means you are going to go short. Going short simply means you are going to place a sell order to take your profit below the current market price. So at 150 current price, I'm taking my profit at 170. So once it gets to 170, the market exit me and take my profit. If If I'm taking my take profit below 150, meaning maybe I'm taking it at 130 or 120, once the market gets to that place, it takes my profit for me and exit me out of the market. So that means it has reached the threshold. So you can take your profit either when the price is going up or that the market is coming down, in a bullish or in a bearish market. Also, same is also applicable when we talk about stop loss. We say stop loss is actually used to control what? Big loss. Stop loss is just a form of risk management. Should in case the market actually goes against you, when the market backfires and does not go the way you predict it, how do you prevent your losses so that your losses will not be much, in the sense that you have to lose everything including your equity? You have to minimize your loss by using the stop loss. Stop loss is a very good, important risk management technique that we use. So if I am projecting that the market is going to move from 150 to 170, I say take profit at 170. Then I should also know that the market may actually go against me by placing a stop loss. So I'll place a stop loss to be below the 150. Maybe I'll place my stop loss to be 140. Should in case the market did not actually go my way, it's now against me. If it started to go against me, please, I don't want to lose too much. I want to lose only 10 pips. That's between 150 to 140. That's what I want to lose. And I'll put my TP at 140. So that is how it works. So stop loss is a predetermined point of exiting a losing trade. The main purpose of stop loss is to ensure that losses won't grow too big. So guys, I've been able to explain vividly the basic topics and things you need to know in your forex trading. Okay, you need to know about the currency pairs. Like I said, you need to know about the major currency, the minor, how to calculate pips. I explained that, how to take profits, take loss, and I also explained the bullish market, the bearish market. I told you when the market is going uptrend, it means it's bullish. When the market is coming down, it means it's bearish. So it's going to be a sell. That means it's a sell order market. Okay, so with all this basic knowledge about forex, you are good to go to start your trading forex. So if this video has been helpful, please do not hesitate to click your comment. Do not hesitate to make a comment, and click also your like button and share and subscribe. Thank you very much. I remain your boy at